This is the Asia Trade. I'm Haidi Stroud-Watts in Sydney, where the market has just opened. The top stories this hour. Asia is set for a subdued end to 2024, with Japan and Korea closed for the New Year holiday. Tech leading a third session of declines on Wall Street. We do get China's December PMIs in a few hours. Also ahead, the US Treasury says it's been hit by Chinese-backed hackers targeting a third-party software provider. Plus, as Australia goes into the new year with elevated interest rates, we get the outlook for consumer sentiment with the Retailers Association. Some data when it comes to South Korean inflation numbers just crossing the Bloomberg at the top of this hour. We're getting South Korean CPI, the month-on-month number, seeing an acceleration of 0.4%. The expectation was for a more subdued 0.2% there, and really reversing the contraction of 0.3% that we saw in November. On that year-on-year basis, it is a gain of 1.9%. That is a little bit hotter than the 1.7% that was expected, and also an acceleration from 1.5%. If you strip out, of course, more volatile costs of food and energy, we are still seeing a pretty stubborn gain of 1.8%. That is a little bit shy of the 1.9% expected, and also receding a little bit from that reading in November, which is 1.9%. But of course, the South Korean economy potentially facing quite a lot of headwinds, particularly with this ongoing political malaise and the risks with the upcoming potential for a snap election and potential further impeachment measures there. We have seen in particular things like industrial production being the subject of quite significant contraction over the last couple of months as well. So weak domestic demand, as well as a slowing global and external picture there weighing on the South Korean economy. At the same time, those moves that we see in the won, that slide on the political side, really limiting the BOK's room to ease very much further at this point too. But let's take a look at how we're trading when it comes to what is, really a pretty subdued end to the year, not least of which because we're seeing major markets like Korea and Japan already on that New Year's break. We're also seeing shortened sessions when it comes to trading in some of these other markets, including here in Australia, New Zealand, as well as Singapore, all seeing more of these truncated holiday sessions today with an early finish. Sydney stocks are down by just about 0.1%. We didn't get a particularly strong lead at all from Wall Street, and in fact, a third day of declines for US shares due to weakness in the tech sector was really the major theme there. We're seeing dollar yen pretty steady at that 156, 157 level. Remember, we heard from Goldman Sachs saying that weakening beyond 160, given the risk of intervention, doesn't seem like a major risk for global investors into Japan at the moment. And watching dollar yuan, given that we do get those China PMI numbers, looking for sort of that final reading before we get into that seasonally key Lunar New Year period for China as well. But let's take a look at how we're setting up when it comes to US futures at the moment, as well as some of the other assets that we're tracking. This is the picture when it comes to US futures, looking like we are going to see that sort of negative risk off end to the year. I will mention the dollar, though, because we continue to see the Bloomberg Dollar Index on track for its best year since 2015. We also saw that rally in Treasuries on Monday, that 10-year yield hovering at about 4.5%. Let's bring in Olga Younger, who is the head of America's Emerging Markets Research and Strategy at Credit Agricole. So we continue to watch that sort of divergent path between the strength that we see in the US dollar and some of the pressure on emerging market currencies, right, and broader EM assets. Do you see some of these factors, what the Fed can potentially do being limited, the risk on the fiscal side for the US, the risk on the trade side and the political side, also from a Trump 2.0 presidency? Are there a lot of risks building at this point for the EM complex?
Yes, Heidi, actually, it's great how you phrased the question. So on the one hand, we certainly maintained quite a bearish outlook on EM, starting with when we published our outlook in November. However, it's true that we've seen already quite a strong move in the US dollar. We do think there is more room still for the US dollar to strengthen, especially versus emerging market currencies. Certainly, we have a number of scenarios we work with. Generally speaking, we do expect that protectionist anti-immigration policies and more pro-cyclical fiscal policy will result in stronger dollar and, all else equal, higher U.S. rates as well. But it's true that at some point, the worst might be priced in.
There are always sort of bears that allude back to what we saw in 2013, right? Do you think the sort of fiscal situations, the buffers that are in place for a lot of these major EMs are much better than when we saw what happened back then, or is there a risk of another taper tantrum?
I would say that from the external vulnerability point of view, EM countries are in better shape. The difference, I guess, between then and now is that between the taper tantrum in particular, was very wide current account deficits among the fragile five that at that time that we observed. I would say from that perspective, emerging market countries are in better shape. We've also seen an improvement in the mix of local currency versus U.S. dollar bonds. So it's not really what we're per se worried about. We do worry about the relative growth between the U.S. and also the diminishing gap between interest rates in emerging markets and the U.S.
There's a couple of major elements that we sort of touched on at the top. One, of course, is the policies that we might see from Donald Trump when he takes the White House starting from next year, and the other is on China. If I can start off with US trade policy, how much of a risk do you see there, and which EMs would be kind of the ones to watch in terms of either the beneficiaries or the ones that are going to be hit negatively?
So everybody makes assumptions, including ourselves. Our base case is that the baseline tariff, the universal tariff, so to speak, would be rather modest, potentially in the range of 3 to 5 percentage point increase. This is less than what we've heard from Donald Trump in the range of 5 to 10%. We do see a phased-in tariff on China, an increase of 20%, but phased in gradually. I would say that this is on the moderate side of things. We expect that many countries will attempt to negotiate with the U.S. and whether attempt to adjust on the side of policies that are important for the U.S., for example, in the case of Mexico, on the side of immigration, to the extent that we see collaboration, then potential punitive tariffs could be reduced or not implemented to begin with. We also could see countries committing to purchase of U.S. goods that could also, in the end, mitigate the ultimate tariffs that is imposed. So at the end of the day, we do see a scenario where it's certainly global trade is under threat, and also in an environment where the U.S. is growing at a relatively high speed. This is still an environment that favors the euro dollar, but at the same time, we, as a base case, do not foresee a calamity.
When it comes to China, it's interesting. We've kind of seen a fading correlation, right, with the rest of the EM complex. Does it still act as an anchor? How much does sort of the fates and fortunes of broader EM still depend on how strong that China recovery is?
It matters a lot. It depends, of course, on where you are. It matters a lot for Asian economies. There are direct trade linkages. There are financial linkages. There are, to the lesser extent, European economies or emerging European economies in the EMEA region. They're less dependent on China. And then if we look at Latin America, for example, some countries are still quite dependent. In the case of Chile, for example, and Peru, through the trade of commodities to a lesser, but to extent in the case of countries like Mexico, Brazil also has an important relationship with China as well. So to the extent that China is impacted, these countries are also certainly impacted. But at the same time, to the extent that we see pro-growth measures implemented by Chinese government, that could also be helpful.
When you take a look at those sort of investable themes, and some of them are negative, right, when it comes to some of the sort of conflict-related, trade tension-related aspects, but are there more positive themes that you would be investing around when it comes to emerging markets?
What I think we might be at some point looking for is point where pessimism reaches its peak. And there are a number of ways to measure investor sentiment. There are fund flows, there is positioning, whether it's on exchanges or surveys conducted by various market participants. And we already see that the market is already quite bearish. So this is one indicator. At some point, there is always a price. And I do think that we could get to a point where valuations adjust sufficiently and positioning reaches its bearish peak where it could be time to get in. Now, the way I guess I would phrase it, whereas we used to think of emerging markets as a growth trade, I think it could become more of a value trade.
How much pressure do you see coming onto LATAM, particularly with some of the idiosyncratic issues that we've seen with Brazil and Argentina? How much does that sort of get worse potentially, depending on the relationship with the US?
Right. So the first one, I guess I would single out, and we've raised those red flags for quite some time, would be Mexico. And Mexico, in the sense that Mexico has got a lot to lose if the relationships with the U.S., the relations with the U.S. sour. It's the largest trading partner. 80% of exports go to the U.S. The economy is highly dependent. Now, we have already seen some signs from Claudia Sheinbaum administration being prepared to accept deportees from the U.S., and we could potentially see more steps to be taken on that front. And ultimately, the most punitive tariffs that incoming President Trump has threatened of 25% in the case of Mexico, and including Canada as well, could be avoided. Nevertheless, we do expect that the USMCA agreement will be largely negotiated, and we could see that while the current business that's already in place in Mexico could be shielded, there will be barriers for expanding into Mexico further. I would say that Brazil...
Olga, we'll have to leave it there. Olga Yango there from Credit Agricole. The US Treasury says it's been hacked by a Chinese state-sponsored actor through a third-party software vendor. It's just the latest in a recent string of breaches that have affected US telecommunication systems. Bloomberg's cybersecurity reporter Jamie Tarabay joins us now from Washington. So, Jamie, what do we know about this latest incident?
We know that the Treasury Department has sent a letter to Congress that basically said that they were notified on December 8 by a third-party software provider, Beyond Trust, that a hacker had gained access to a key used by the vendor to secure a cloud-based service, and that would remotely provide technical support for Treasury departmental officers. Based on the available information, the hackers have been tied to the Chinese state. And so this is the latest that we've seen in yet another hacking campaign by Chinese state-sponsored hackers to delve inside U.S. critical infrastructure, U.S. government agencies, and of course the telco networks, which is one of the biggest hacks we've been covering this year.
Have we heard any sort of response from Beijing?
We got a response from the Chinese embassy in Washington. They have really sort of rejected the comments and the findings. They've said that they oppose U.S. smear attacks against China without any factual basis. In an email to me, they said the U.S. needs to stop using cybersecurity to smear and slander China and to stop spreading all kinds of disinformation about the so-called Chinese hacking threat.
This, of course, comes at a time where we expect to see continued or potentially, accelerated tensions going into a Trump 2.0 administration. Do we know if sort of dealing with this sort of cybersecurity threat is a priority for the incoming administration?
But we've been having some conversations with Republicans on the Hill, as well as folks within the incoming administration, people who are being tapped by President-elect Trump to take over important cyber roles. It's particularly interesting because given the tension with China and how President-elect Trump wants to establish good, positive ties, at the same time, he has to contend with the reality that Chinese hacking groups hacked his campaign in particular and accessed phone calls of him, his running mate, his family members, and campaign staff. So this really is a personal issue for the president and it's going to be very interesting to see how he manages to balance the push for national security and sovereignty over the economic and diplomatic objectives that he wants to pursue with Beijing.
Bloomberg cybersecurity reporter Jamie Tarabay with the latest there in Washington on that top story. And some of the other stories that we're following this hour. US President-elect Donald Trump has endorsed Speaker Mike Johnson, avoiding a potentially crippling leadership fight in the House. Johnson also earned the backing of Elon Musk, who has become, of course, a close advisor to Trump. The House is set to hold its vote for Speaker on January 3rd. US stock markets will be closed on January 9th to observe a national day of mourning for the former president, Jimmy Carter. The closures are a long-standing American tradition in which financial institutions halt operations following the death of a president. Carter died on December 29 at the age of 100 and was the longest-living US president in history. Sunday's Jeju air crash has prompted South Korea's feuding political camps to temporarily halt a protracted power struggle. For more, let's bring Bloomberg News reporter Soo-hyang who joins us out of Seoul. And Soo-hyang, how are we seeing this kind of have an impact on the ongoing political crisis? What's the response being given? Of course, the leadership that's having to deal with this disaster has only been really in place for the last few days.
This is indeed a challenging moment for South Korea and its acting president, Choi Sang-mok. It's been only 2 days after Choi assumed his job as the acting leader. It's not the first time South Korea was under the leadership of an acting president, but the challenge that Choi is facing is unprecedented in that he's now leading a cabinet without a safety minister, without a defense minister, and a prime minister, all of whom have been either impeached or resigned following their alleged involvement in the martial law declaration. So there is lingering concern over how well South Korea could respond to this disaster with such a leadership vacuum.
There's obviously just national devastation in reaction to the aviation disaster, right? And I do wonder how that sort of adds into what the public support and patience is for this ongoing level of political turmoil.
The tragedy has quickly plunged the whole nation into grief. City governments are calling off events or scaling back them that they had planned to celebrate the new year. It's been only 2 years since South Korea saw more than 150 people die from a Halloween crush. So the government officials, as well as the politicians from both the opposition and the ruling party, are well aware how quickly the public sentiment could go if these kind of tragedies are not properly handled and if the victims are not properly taken care of. So the Democratic Party, which has been grilling government officials over the martial law in the past weeks, have called off the parliamentary sessions to head to Muon to meet the victims, and they have been refraining from harsh rhetorics to impeach the acting president, Choi, and they do appear to be very cautious not to make this public sentiment turn against them.
You know, I remember in the aftermath of the Seawall ferry tragedy, how we really saw, domestic politics and the economy really becoming intertwined in the aftermath of that. Do we see this tragedy as having an impact on the impeachment trial, the ongoing investigation, what potentially the opposition chooses to do from here?
Many of the analysts that we've spoken with said that the political parties will likely refrain from engaging in a major political wrangling, at least until the mourning period ends on Saturday. But the Democratic Party, which controls the parliament, is unlikely to change their basic strategy, which is to oust the president as soon as possible. And that is in part because the opposition leader Lee Jae-myung himself is facing a trial over corruption allegations. And if his conviction at a lower court is confirmed at a higher court, that could bar him from running for next presidency. So while we do see this political fight slightly muted, at least for now, it's very likely that the political turmoil that South Korea is facing is likely to continue at least until the Constitutional Court rules on Yoon's impeachment.
Bloomberg Soo-hyang Choi there. And speaking of, we are getting that update when it comes to the acting president Choi likely to exercise the veto on the special counsel bills at a cabinet meeting to take place on Tuesday. This is according to reporting from Choesung, and it says that he could potentially investigate insurrection charges against President Yoon, multiple allegations against the First Lady as well, according to the Chosun Ilbo newspaper. The acting president may ask Parliament to reconsider the bills. He has until the 1st of January to either promulgate the bills or ask Parliament to reconsider. More ahead on the Asia trade. This is Bloomberg. New Century Advisors Chief Economist Claudia Sam is warning about potential blind spots for the economy in 2025.
If we could keep it as it is right now, largely, this would be another great year ahead of us. You know, we've been surprised at how well the past 2 years have gone, particularly when you think about growth and how the consumers have held up. But that doesn't have to keep going. So what we really want people to focus on are the blind spots, right? What could go wrong? Who isn't getting enough attention? And I think one area, you know, if I had to maybe point some Fed officials to a blind spot, I think, you know, they showed a lot of complacency in their last summary of economic projections on how well the labor market would continue to hold up. You know, what we saw them kind of write down, the typical official, was something that basically has the unemployment rate sticking about where it is right now for the next 3 years. That's a pretty remarkable and frankly would be very unusual path to the labor market. And yet there was all kinds of concerns about inflation and the uncertainty around inflation. But I think I'm still concerned that there are things in the labor market, while good, don't quite look like sustainable. And that's where the problems can come in, and so that's one area that I think is Claudia.
So if I ask which is a bigger risk, a weakening labor market or a stubborn inflation, you're going with the former rather than the latter.
Inflation's fine right now. I mean, we are really not that far from 2%, and we've seen a lot of encouraging signs under the hood that we are getting to this last mile on inflation.
But right now,
the labor
that's
market
before tariffs. That's before we deport millions of workers. That's before Donald Trump comes into office. So things could change drastically after January 20th.
Absolutely. They could change drastically. And I think it's appropriate that we have had a very deep conversation about the policies that have been put on the table. And there have been a lot of policies put on the table. And it's really important to have this conversation and talk about some of their potential pitfalls. And maybe we won't see all of them put into place. And that probably would be a good thing for the economy. And yet, you know, kind of taking for granted the good stuff that we've got going in the economy that's a little more nuts and bolts, like the labor market functioning, and just saying, oh, well, that'll just keep going. That's all fine. It's in a good place. I think that's that could be a real mistake in terms of, because the labor market in particular is always and has been the past few years such a linchpin to this amazing period of a big disinflation. Growth has stayed strong and unemployment has stayed relatively low. You know, and that's something we want to keep going.
More ahead on the Asia trade, this is Bloomberg. That time of year when we start taking stock of the performances across various asset classes over the past year, and take a look at this chart that shows you the performance of gold versus the rest of the metals markets. It's been really that standout with that 26% advance this year. It has been otherwise a pretty mixed year for broader metals markets. That 26% gain in 2025 for gold really being driven by Fed easing, some of the geopolitical risks, of course, a number of conflicts ongoing, particularly in the Middle East, as well as central bank purchases as well. When it comes to other metals, though, it has been a little bit of a choppy year. Base metals seeing some modest gains. We've seen that 28% tumble for an iron ore. Lithium experiencing a second annual decline there. So going into 2025, the risks are plentiful, right? Uncertainty around how much the Fed can do. And that's really hinging on uncertainty around the outlook for US fiscal policy and trade policy going into a second Trump presidency, China's growth and pro-fiscal efforts for 2025 and how much stimulus and how effective that's going to be as well. All of that is going to wrap into where we see metals prices go for 2025. And the question is also whether the strong gains for gold this year that have really seen a succession of records, whether we see that shift in the market's dynamics given they've come despite a stronger US dollar this year and rising real yields in treasuries. Both of those are typically headwinds and they've had less of an impact this year for gold. So it has been quite remarkable as well as just the strength that we've seen in that gold rally. But when it comes to the performance in particular of those industrial metals, we talked about the tumble in iron ore. So much of that is down to China. We've got those December PMIs coming out in a couple of hours' time. This will be the latest reading on a recovery that remains mostly elusive despite stronger stimulus. Our China correspondent Min Min Lo joins us now from Hong Kong. So, Min Min, what are we expecting?
Yeah, so according to economists' forecast, we're looking at pretty mixed numbers this month. The manufacturing PMI expected to tick lower to 50.2, down from 50.3 the previous month. This is largely because of seasonal factors at the end of the year. And the non-manufacturing PMI expected to tick higher to 50.2, up from 50 the previous month. This is largely boosted by an increase in travel-related services and a rebound in construction. But still, overall, it doesn't show a very solid recovery despite the stimulus measures that we have seen so far. Although if you look at the Caixin PMI, that has outperformed the official data. That is because it largely captures those export-oriented firms, and we do expect exporters to front-load shipment this year before Trump gets inaugurated next year. And also, if you just peel back the layers, look at some of the sub-indices like employment for both manufacturing and services, that's hovering around 48 and 45 respectively, which shows that there's still a lot of pessimism around hiring. So still further consolidation needed for the economy, even though we do see pockets of recovery in activity.
President Xi is set to give his New Year speech later tonight as well. Is there going to be anything of note for traders?
Well, this is a speech that he gives every year. It's typically a speech for him to really connect with his domestic audience and to show his care for the livelihoods of ordinary citizens. So he is likely to highlight some of the achievements and challenges that China has faced this year. He might give quite a positive report card for China and just talk about some of the breakthroughs China has made in terms of, for example, science and tech or space innovation, for example. He will likely also set the tone for next year and also emphasize the government's priority to continue looking out for people's livelihoods and address issues related to social welfare. And investors will be looking for any affirmation that he has with regards to the government's efforts to continue reviving the economy next year. But don't hold your breath for any market-moving information because, as I said, this is usually a sort of feel-good speech at the end of the year to wrap up the year and to really connect with his domestic audience.
And of course, so much risks, but also opportunity as we potentially get into, a year in 2025 where we finally see a lot more stimulus and fiscal stimulus from China, right? What will you be watching in terms of where we could see the biggest beneficiaries, where that stimulus will come through to?
Yeah, I mean, for all the talk about how slow the Chinese economy is, if you look at the stock markets, it actually has been doing pretty well this year. If you take a look at the comparison between the CSI 300 and the HSI versus the broader Asian benchmark, the Chinese stocks have been underperforming throughout most of the year, but they really rallied on the stimulus measures in September, taking them to a high towards the end of the year, outperforming the broader Asian benchmark, and the CSI 300 is having its best best year since 2020. The HSI is having its best year since 2017, boosted by that 19% gain in September. And looking ahead to next year, obviously the government has already pledged to take measures to stop the decline in the property sector and to really prioritize boosting domestic private consumption. So if you look at the consumer staple stocks this year, those have been the laggards in 2024. We expect those stocks to benefit from some government policies, especially when it comes to childcare, elder care related stocks because of policies related to boosting social welfare, for example. And of course, the tech stocks as well, some of the best performers this year, really riding on the back of China's self-reliance push. And there you go. You can see on that screen there, financials have been doing very well this year as well. That's really boosted by the SOE's pledge to give out higher dividend payouts. We continue to expect record payouts, interim payouts in the first quarter of next year.
Bloomberg's China correspondent Min Lo there. Let's get the latest when it comes to some of these corporate headlines that we're following. And as the year draws to a close, we've seen a flurry of IPO filings in Hong Kong for early 2025. Yibin Bank is seeking up to $245 million, trading set to begin on January 13th. Other firms joining the frenzy for the year end include WeDoctor, Brain Aurora and Contiocean. Venezuela's top court has imposed a $10 million fine on TikTok over viral challenges that killed 3 children and injured dozens of people in recent months. It also ordered TikTok to establish an office in Venezuela. The judges say money from the fine will go towards compensation and a fund for victims. India's Adani Group is getting out of its consumer joint venture Adani Wilmar in a $2 billion multi-phase deal. An exchange filing shows Adani Enterprises will sell its 44% holding in stages to Singapore's Wilmar International. Adani plans to use the proceeds to bolster its core infrastructure business, including air transport and renewable energy. Separately, the CEO of Adani Green Energy, Amit Singh, will step down at the end of March to assume a new leadership role within the conglomerate. Singh will be replaced by Ashish Khanna, who currently leads the group's international energy business. The change comes as the company faces US allegations of offering bribes to get power contracts. We're also watching Nissan at the moment, with shares, of course, having come under pressure for a couple of days now as investors have really been taking profit. That 2-day drop of about 13% is what we're watching at the moment when it comes to Nissan. The concerns over the terms of the planned deal with Honda potentially giving investors a lower stake in the proposed joint holding company. We saw that decline very early in the week of 6.7% in Tokyo. We did see that big jump of more than 60% since December 17th. That was the day before the news of the deal actually broke. But we have seen, of course, that tumble after Christmas as investors really turned their concerns to the starting ratio for a Honda-Nissan tie-up. We've also seen quite a bit of profit taking, of course, with that last trading session of the year. Well, the man who engineered Nissan's tie-up with Renault says the Japanese carmaker's new plan for a possible merger with Honda shows it's in panic mode. We spoke last week with the former Nissan chairman, Carlos Ghosn, who's been living in Lebanon since his dramatic escape from Japanese custody 5 years ago.
It's a desperate move. It's not a pragmatic deal because, frankly, the synergies between the two companies are difficult to find. There is practically no complementarity between the two companies. They are on the same markets. They have the same products. The brands are very, very similar. So in a certain way, from one side, Nissan, it's a desperate move to try to find the future. And from the other side, Honda, which, if I understand well, they were not very excited about this move. But, you know, you have to count with Meiji in Japan. That means the Meiji had a big say into it. So at the end of the day, they're trying to figure out something that could marry the short-term problems of Nissan and the long-term vision of Honda.
Do you think Nissan is being do you think Honda is being pushed into this deal by the economy ministry? There's politics pushing this deal, Carlos, rather than the value of the deal?
Without any doubt for me. That means having lived in Japan for so many years, I understand how influent can the Meiji be. And I can tell you that, from all the data that I received about the performance of Nissan, which has been miserable for the last, at least for the last 2 to 3 years, they have cash problem, they have investment problems, they're being really hammered in the United States, they got practically out of Europe, they're being challenged in China, and there is no plan in front of it. So I can tell you that there is panic mode inside Nissan.
You've dealt with the Japanese, you've dealt with Nissan, you understand the metrics to get these organizations together. Is the government going to have to deliver backstops to Honda to make this deal work?
No, I think they in a certain way, tried to push Honda onto this deal. Obviously, Honda must have some kind of benefit out of it, if not on the short term, at least on the mid and the long term. But that will be closely monitored to make sure that the impact on the Japanese society is not going to be too big. Because, when you have two companies of this size and practically in the same market with practically the same strengths and the same weaknesses, there are going to be a lot of costs to be taken out, and there are going to be a lot of duplication to be taken out. So this is going to be closely monitored by the Met. It's
driven by the Ministry of Economy. So there's a political dynamic to this. Is this Japan creating, putting two companies together to really try and stand up to the competition from China? Is that part of the narrative here, Carlos?
Without any doubt. It makes a lot of logic. Today, the Chinese automakers are on the winning side. They became, as you know, the largest exporter of cars. They are the largest maker of EV. They are being successful in a lot of new technology. They're doing fine cars. So in a certain way, yes, it's a defensive mood. It's a defensive mode that's going to be trying to shore up the Japanese industry and avoiding a cataclysm, first a social cataclysm in Japan, and particularly to try to reinforce these companies on the foreign markets.
Of course, that was the former Nissan chairman, Carlos Ghosn, speaking to us last week. More ahead on the Asia trade. This is Bloomberg. Taiwan is looking to cut its greenhouse gas emissions by as much as 30% by 2030. It's an upgrade from its previous target. The island is behind schedule in achieving its initial targets to bring sufficient renewable power online, with delays plaguing the rollout of infrastructure and offshore wind facilities. We are also seeing an ambition when it comes to Japan as well, setting the new target to cut greenhouse gas emissions by 60% by 2035. They're aiming to reach net zero by 2050. This is a plan that is not without its controversy. In fact, is facing criticism for being lacking in ambition. Some are arguing for a higher target of 75%. Achieving net zero would require significant investment in Japanese energy, with estimates suggesting that number to be at $7.7 trillion through to 2025. So these reductions from 2013 levels will put Japan among the world's top carbon polluters, on track to hit net zero by 2050. So we're seeing Prime Minister Ishiba's government following countries, including the UK and the US, in setting out upgraded emissions cutting commitments ahead of February, which is when we see that emissions deadline for nations to submit their new climate targets under the Paris Agreement. Previously, they had set that target of 46% by 2030 from 2013 levels. The criticism, though, kind of speaks to some of the disappointment for climate negotiators and climate transition supporters this year, because a lot of these conversations and the negotiations across the climate diplomacy space has really failed to produce significant agreements through 2024. We saw, in fact, hostility characterising talks on climate change at COP29 COP29. The talks when it comes to cutting plastics pollution failed to materialise an agreement, and we didn't see an agreement at COP16 on biodiversity protection either. So at COP29, we saw that deal that left a lot of developing nations unhappy with the amount of money that was agreed upon to help them battle global warming, avoided mentioning the need to move away from fossil fuels in that agreement as well. So we're really seeing kind of the stagnation being caused by political polarisation, the influence of big corporate, of course, strained government budgets as well during a difficult time economically for a lot of these countries. All of this making nations overall just less willing to compromise on climate, and that's led to some watered down agreements that really are being seen as being failing to address environmental issues very effectively. So when you take a look at the sort of gathering that we saw of nearly 200 countries in Baku in Azerbaijan, a lot of that disappointment really coming through from COP29 there. Well, Fortescue founder Andrew Forrest says he's still optimistic about global energy transition efforts. That's despite the setback that we've seen at this year's UN Plastics Summit. Nations there, of course, failed to agree on a treaty to curb plastic pollution. He spoke to us earlier this month from the Bloomberg NEF Summit in Shanghai.
The failure of that summit was utterly predictable. The fossil fuel sector sent 300% more lobbyists than there were countries represented. You have what's called a consensus, but it actually means everyone has to agree. So one plastic producing country can just stop progress for the entire world. So it's clearly a system which isn't going to work. That's now proven after a 5-year lesson. We have to go about it another way. Plastic is harming human health. It's harming the whole ecology of our planet. It must stop. These people really need to get their head across it. But as to the energy transition, Haidi and Sherry, yeah, look, there's issues on the horizon, but am I optimistic? Am I close to the breaking technologies which are coming down the barrel at us now? Yes. Fortescue's, yes, I am. I can see the changes coming. And basically, if North America wants to slide back into oil and gas, coal, good luck to it. Its citizens, its companies, its investors will put up with this gyrating energy cost. They will put up with the fact that their cost of living from energy will be dictated by despots, dictators, oligarchs, who they will never know. When you've actually got this massive social transition happening in the rest of the world, where the power is coming out of these huge companies and players into the hands of the people, into households, into companies, even countries. And that's this massive social transition, which the fossil fuel industry can see its grip sliding down the pole, and it just has to happen. Economically, look, am I really excited that we've got technology that can charge our trucks at 6,000 kilowatts in half an hour, that can charge cars in 30 seconds? Am I excited that we're bringing down the cost of making hydrogen massively? Yes, I am. And I'm just seeing this massive transition in history happening. And if those countries who follow renewable energy will grow stronger, take China, and those who don't will slide back, take North America.
You just mentioned North America, so let's talk a little bit about President-elect Donald Trump. I know that his transition team has already approached your team. Have you had direct conversations? And how will you try to change his mind when it comes to really fossil fuel and the reliance on oil?
Look, President-elect is an economic pragmatist, and he's also won an election in large measure on creating fear about the wind back on renewable energy, creating fear about China. You put these two things together, there's one country being enormously economically pragmatic, Sherry, and that is China. It will account for 50 to 60% of all the solar energy both produced and installed in its own country before the end of the decade. It will have this rising and steady growth in standard of living of its citizens. Those who pulled back on it, who've created fear by saying, hey, look, cost of living might go up. Now, there's a war in Ukraine, there's a war in the Middle East. Let's not change now. It's a bit risky. Well, actually, that is the time to change. And of course, North America has this wonderful opportunity to go surging ahead for its citizens, but if it tracks back to oil and gas, Sherry, it's just going to see this economic transition happen. You've had the Chinese economy once easily the biggest in the world centuries ago, and it'll just go back there quicker now.
Andrew Forrest there, of course, the founder and executive chairman of Fortescue. Let's take a look at what we're watching when it comes to broader commodities and oil in particular. For the year, not much to speak of, heading for that modest annual loss as investors really looking ahead to some of the risks and opportunities for 2025. But we have spent months when it comes to crude trading locked in that narrow trading range. And of course, China's persistent demand weakness aspect, as well as the ongoing conflicts in the Middle East and Ukraine, really the big thematics for this year, despite a very strong start to 2024, but it's been stuck since then. But I will mention bullish oil bets have hit at that 4-month high in the last week of 2024. So clearly we are seeing some crude investors positioning for a new year and potentially the impact of Donald Trump. Well, what a year it's been for cryptocurrency. I should say, what a year it's been ever since the US election, right? That rally really being sparked by Trump's election victory. It's now seeing a little bit of a stalling as we close out 2024. We've seen Bitcoin's price dropping about $15,000 below its record high that it was hit back in mid-December. So some of these expectations for rate cuts from the Fed have cooled the speculative frenzy, perhaps, that we've seen across Bitcoin. But of course, so much of this is being driven by President-elect Trump's preference for crypto-friendly regulations, of course, the role of Elon Musk as well, support for the idea of a national Bitcoin reserve, lifting digital assets there as well. But some of that scaled back expectations starting to weigh as we close out the year. We will hope to get more clarity when it comes to the US crypto regime, perhaps after January 20th, when we do see President-elect Donald Trump taking over the White House there. And it is expected that his position will contrast with that of the Biden administration, which has really sought to crack down on the scandal-prone crypto sector. The other thing we're watching, of course, is the aftermath of BlackRock's Bitcoin fund becoming, and I quote, the greatest launch in ETF history. The iShares Bitcoin Trust has grown to over $50 billion in assets in just 11 months. This would make it the fastest growing ETF in history. It's driven Bitcoin's price past $100,000. It's also brought in pretty critically institutional investors, as well as some individuals that were previously skeptical of crypto more broadly. So that ETF growth giving BlackRock something of an edge in the market, and some industry participants have criticised the SEC for deviating from its usual first come, first serve process and giving later entrants an advantage. Certainly one to watch for 2025. This is the Asia Trade, and we are, of course, heading into that last trading day of the year. And in fact, we've had the last trading day for a number of major Asian markets already. Japan and Korea are already closed for that New Year holiday. And here in Australia, as well as over in New Zealand and Singapore as well, they'll be seeing shortened holiday trading sessions as well. So an early mark for some of the investors and traders here in Oz. But take a look, it's a pretty characteristically muted session as we head into the holiday for New Year's Eve and New Year's Day. But this is a picture as we've had an hour of trading for the ASX, pretty muted. But we are expecting, in terms of the really outlook for further gains for Australia, that's looking pretty positive heading into 2025. We have seen a number of pretty record highs there, and that is really expected to continue the record-breaking rally there for Aussie stocks in particular, really getting that access to easier central bank policy. China's stimulus pledges, if they come through, will be a big impact for Australia as well. Mining in particular is one to watch if we have that further stimulus from Beijing. The banking sector, though, could be seeing some earnings compression from net interest margins, and that could be one to watch in terms of the potential downside. A lot of that depends on where the RBA goes as well, but at a minute we're seeing about 0.6%, a second day of losses as we head into the last trading session for Australia. The Aussie dollar is much unmoved, 16 62.19 at the moment. Of course, the persistence of that dollar strength story continues to be a big one as we go into 2025. And watching treasuries there as well in what is otherwise a pretty muted last day of trading here in Asia. Let's take a look at some of the outperformers for the year, though, because some of these we have already talked about. Gold in particular, that 26% advance, really it's sticking out given what we've seen across the rest of metals being quite mixed, right? Particularly when it comes to industrial metals and base metals. Iron ore, of course, tumbling 28%. Lithium seeing that second annual year of declines, I should say. And some of the other sort of notable winners that we've seen, a lot of them are the sort of AI chip-related names, the Mag 7, the Nasdaq 100, trading on the TAIEX as well as Japanese equities as well. Indian stocks have been a particularly interesting one because we did see that the broader concern over sluggish consumption in the Indian economy, really seeing foreign investors start to pull out 989.5 billion rupees from the Indian stock market since the start of October. That has more than halved the benchmark Nifty 50's index annual gains to over 9%. But at the same time, what we're seeing now is record yearly inflows from retail investors. So mom and pop investors really starting to come back into the Indian market. So that'll be a theme that we're watching for 2025. The other theme, of course, is Bitcoin, as we've seen really the ascent of Bitcoin to new highs following the Trump election victory. Some of that has stalled going into the end of the year, but we'll be looking for more clarity on what this sort of new crypto regime looks like for the US going into January 20th when we see President-elect Trump take office. A lot of uncertainties, a lot of opportunities, certainly, as we head into the new year. Let's bring in Vishnu Varathan, who's the head of economics and strategy at Mizuho Bank. Vish, great to have you with us, and I'll say a happy new year, or almost new year. What are you most excited about for next year, and what are you most worried about?
Happy New Year, Heidi. The worried question seems easier to answer than the happiest about question, but that's just a reflection of my nature, not 2025 in and of itself. But let me frame this as the upside, surprises we can see in 2025 versus, some of the lingering risks that could remain in place. I'll start with the markets. As you rightly pointed out, we've seen a lot of exuberance in some parts of the markets. At least some of these have been attributable to the Trump trades, the so to speak Trump trades. What remains to be seen is the shakedown from it. I mean, I think the tires need to be kicked, and then the clearer picture emerges on what will continue to stick. So, for example, whether technology continues to stick, and the AI-driven exuberance extends in the markets. Also, in terms of cryptocurrency deregulation, we want to see the pace because a lot has been priced in. So, execution and pace will also matter. There's a certain degree of Trump reflation traits that are being factored in, and that involves two components. One is it's going to be positive for growth, at least for U.S. growth. So there's an element of U.S. exceptionalism, coupled with inflation that might be stickier or slightly higher, which then knocks onto the Fed policy projections, and therein we get higher yields, so on and so forth. It'll be interesting to watch how that plays out against Scott Bessent's view of trying to get the fiscal deficit down, not up, as markets project, alongside a lot more energy production, which should be disinflationary. And tax cut versus spending might have a slower money velocity impact on the U.S. economy. So we might end up getting more Fed cuts than we are currently pricing in. So that's certainly one area to watch, because it would then have an impact on how much higher yields can go, and in fact maybe reverse back, and how much steeper the curve can go, because the Fed cuts usually gets us to a steeper curve as well. So these are perhaps some parts that we are watching. Surely for the equities part, we think there's going to be a lot more differentiation. And for the dollar, I think that remains the biggest question. The big dollar has really dominated the markets this year. Whether that can continue unfettered next year is the big question. Of course, we've been big fans of the dollar not relinquishing its position despite Fed cuts. But there is a narrative for a slightly softish landing for the dollar if we get to the point where U.S. exceptionalism is tempered, not completely thrown away, but but at the same time also get to where Fed rates can be slightly lower. So we get the dollar back under 105, maybe between 100 to 103, rather than going towards 110. So there are many different moving parts in this equation. The biggest one that we watch in Asia is the Trump trade tariffs. Whether the bark is louder than, a lot more scarier than the bite. That is really something that we want to keep a close lookout on, because our key risk, and I'll just stop here after this, our key risk is China's response function this time around could be a lot different to that what it was in 2017, 2018 episode. And that's where some of the unknown risks lie, whether it becomes a retaliatory spiral or not.
Vish, I wanted to dig a bit deeper in terms of your expectations from the Fed and how, you talk about this being an atypical easing cycle. How atypical is it? And is that sort of atypicalness just a quirk that speaks to sort of how surprisingly robust many aspects of the economy has been? Or is it a reason to be more cautious?
That's definitely something that we want to watch for. The first area where it became very atypical was the speed with which rates had accelerated higher and then stayed higher for longer for a bit, and nothing broke. So that's in and of itself quite remarkable. We've probably had about the longest run of an inverted yield curve earlier, which of course has now begun to normalize again. But regardless, that's one part of it. The other part was the dollar remained really strong into this. And that's quite atypical. The dollar should have declined way before the Fed started cutting rates. And so that informs us and reveals that we are in a place where the alternatives to the dollar are in far worse shape than they historically have been. So fundamentally, the currency market response function is different. We also have, it's also atypical in the sense that this is the first time we've seen the Fed hiking at the pace that it did, coming out of a pandemic. The Bayesian probabilities around those tell us that this is not going to happen very often. And so there remains that lingering question, even though we've derived greater comfort of a soft landing, there remains that lingering question whether the policy legs are indeed different this time and whether we shouldn't give in completely to complacency at this point. And especially if we are going to maintain rates higher, because the bifurcation in the economy is also far greater. I think households feel a lot more cash flow strains than asset markets have shown. So those would be the big things that the Fed grapples with. And I think the Fed's narrative and playbook will remain highly narrative and highly volatile. So this is not done and dusted. If we recall back in June, the Fed had a slightly hawkish inflection where it said it would cut less than it indicated earlier. September, it changed that view to become more dovish. December, we've gone back to the dot plot saying, not that many rate cuts, folks. So 2025, I don't think is going to be a linear projection. We do see a risk that the Fed might have to cut deeper and faster, especially if the reflation story in the US doesn't play out and cash flow constraints start to bite. So I think the biggest unknown around this is how long the US exceptionalism lasts, whether the Fed policy response then becomes very fluid, and the policy dilemmas it creates for other central banks, be it across the Atlantic for the ECB or in Asia for Asian central banks, where the need to cut rates is growing, but the Fed's elevated rates are to understate an inconvenience with a sharp trade-off on currency volatility.
You're even less optimistic, or say even more pessimistic when it comes to China, right? A lot of these concerns about the confidence deficit, the deflationary spiral, as you say, the fallacy of, trying to fill one gap with another, which, to be fair, I think has been happening for a number of years in China. Has this all sort of come home to roost at this point? What do we see in 2025? Can they successfully pull this off?
Yeah, on China, I think it is really a complicated beast. And the tragedy is China actually has the capacity to do a lot better despite the binding and the multiple constraints on it. And perhaps for clarity's sake, I'm less worried about the trade tariffs on China. Is it a huge external headwind? Yes. Would it dislodge China as the dominant manufacturer of the world. No, China's advantages are such that it does not be in any shape or form, meaningfully challenged in the near term, and it retains a lot of key advantages. And so for me, where my pessimism from China on China stems from is the onshore policy strains and economic strains that are not adequately addressed. Our sense is that the central government needs to step in a lot more unequivocally to ensure that the confidence deficit, the chronic confidence deficit, is snapped, because that's key to getting a lot of the growth multipliers going from the stimulus efforts. Whereas the stimulus efforts, hampered not unjustifiably by moral hazard questions, mean that it is very difficult for China to shake off the sluggishness, given the depth of the confidence shaken, alongside the property market constraints, the local government's inability to spend, and a lot of haze hanging around incentives and corruption charges, which hampers banks from being more unfettered in lending. So that confluence of constraints that China is facing, that's the reason why we are not as upbeat, despite a lot of signals from China that they are going to provide more stimulus. And it's really inconvenient that the tariffs are coming on now. So the tariff is not the boogeyman, but it's come on at a time when China has got enough challenges. That's the real threat here.
Vish, always great to chat with you. Vishnu Varathan, Head of Economics and Strategy at Mizuho Bank. Certainly not a super optimistic view of 2025. Lots of challenges there. Let's take a look at how we're faring in this very truncated session, because we do have markets like Japan and South Korea already closed for the New Year's holiday there. We are seeing a shortened trading session for Australia, New Zealand and Singapore as well. Aussie stocks are down by about 0.7%. It is looking a lot more optimistic when it comes to the extension of this record-breaking rally that we've seen for the ASX 200 going into 2025. The Aussie dollar not seeing too much of a move, but of course just that ongoing strength of US dollar dominance, a higher since 2022, will be a major theme going into next year. South Korean markets are closed today, of course, for the New Year holiday, but we did get the hotter than expected CPI numbers coming through. Inflation in South Korea really picking up at the same time that we continue to see this ongoing political fallout really spreading as we head into 2025 with a high degree of political uncertainty for Korea. And this also further complicates the sort of room that the Bank of Korea has to cut rates next year, despite these ongoing growth concerns. The Finance Ministry making some comments when it comes to the CPI numbers in a statement warning that we could see further upside pressure in January CPI reading, even more so than in December on the back of oil prices, but also saying that for 2025 more broadly that CPI will slow more than this year's 2.3% that we've seen. So potentially we'll have to watch to see what the implications are for the policy equation for the Bank of Korea, especially given the weakness that we've seen in the Korean won as well. Well, Sunday's Jeju air crash has prompted South Korea's feuding political camps to temporarily halt a protracted power struggle. For more, let's bring up Bloomberg News reporter Soo-hyang, who joins us in Seoul. So, Soo-hyang, how do we see the ongoing political crisis really impacting the response to this disaster?
This is indeed a challenging moment for South Korea and its acting president, Choi Sang-mok. The tragedy, which killed at least 179 people, happened just 2 days after Choi assumed the role as an acting president. It's not the first time South Korea has been under the leadership of an acting leader, but the situation that Choi is facing is unprecedented in that he's now leading a cabinet without a safety minister, without a defense minister, and a prime minister, all of whom have either been impeached or stepped down over their involvement in the martial law declaration. So there is lingering concern over how well South Korea would be able to handle the aftermath of this tragedy under the leadership vacuum.
What about the reaction, both politically and also the broader public? Is there support there? And, how do they really want their government now to react, given all of the uncertainty?
The tragedy actually really quickly plunged the whole nation into grief just days before the new year. The city governments are calling off their plans to celebrate the new year. And it's been just 2 years since we saw more than 150 people killed in a Halloween crush in 2022. So the government officials, as well as the politicians, both from the ruling and the opposition parties, are well aware how quickly the public sentiment could go bad if these kind of tragedies are not properly handled. So the Democratic Party, which controls the parliament, that has been holding a series of parliamentary sessions to grill government officials over the martial law, have canceled those meetings and had it to Muan, where the incident took place. And they have also been refraining from making harsh rhetoric, openly threatening the impeachment of acting President Che. So they do appear to be shifting their focus now from the political fight to this disaster response.
You mentioned the impeachment trial. Does that have an impact then in terms of what we see going on, the ongoing investigation as well?
Many of the analysts that we've spoken with said that while the political fight will likely remain slightly muted until the mourning period ends on Saturday, the broader strategy of the DP will likely remain unchanged. That is partly because the opposition leader, Lee Jae-myung himself, is facing a trial, and if his conviction at a lower court is confirmed at a higher court, that could bar him from running for the next presidency, and he's considered a top contender for the race at this point. Separately, we are still waiting for a court decision on after investigators sought a warrant to arrest President Yoon. If that warrant is granted and executed, that would mark the first ever case for any sitting president of the country to be arrested while in office. So while we do see the political wrangling a bit muted at this point, this political chaos will likely remain and uncertainties will remain pretty high, at least until the Constitutional Court rules on Yoon's impeachment.
Bloomberg Soo-hyang there with the latest. And we are getting that Bank of Korea reaction when it comes to the hotter than expected South Korea CPI numbers for December. The BOK saying in a statement that the CPI inflation numbers will stabilise to below 2% after January. Again, they also echo what we've just heard from the Finance Ministry as well, saying that the January inflation number may also accelerate again on a weaker one, in addition to, of course, that pressure from oil. But, of course, these really complicating the outlook for the BOK in terms of how much they can potentially ease despite the downside pressures on the Korean economy. Well, the US Treasury says it's been hacked by a Chinese state-sponsored actor through a third-party software vendor. It is the latest in a recent string of breaches that have affected US telecommunications systems. Our Bloomberg editor, John Harney, joins us now from DC. John, great to have you with us. So what do we know about this latest incident?
Well, it like you said, involved a third-party software provider. This was reported by the Treasury in a letter to Congress on December 8th and only became publicly known today. The Treasury says that these hackers be able to gain access to workstations at the Treasury, and that certain unclassified documents were were obtained or seen by them, but that the breach, that whoever was behind the breach no longer has access to Treasury files.
Jen, do we know what sort of response that we have had from Beijing, and also how much of a priority combating cybersecurity risks and threats from, some of these nations, including China, will be for the incoming Trump administration? Well,
of course. I mean, that's certainly one of the many China-related. It's on the China agenda for the new administration, including, of course, what happens to TikTok, Taiwan, etc. But the Chinese embassy here in Washington has, didn't specifically deny this accusation, but said it was involved, that this was basically a smear, then more invective against China that really has no basis in reality. But this of course comes as you mentioned after the Salt Typhoon cyber espionage that involved several American telecom companies, and who were able to gain access to personal information of those companies' customers. So it's a continuing. It's all part of the continuing struggle between two adversaries, and it will continue into the new administration.
Bloomberg News editor John Harney there in DC with the latest. More ahead on the Asia trade. This is Bloomberg. Take a look at what we're watching when it comes to trading in FX at the moment. The dollar is really the one that we're watching, right? The dollar gauge on Monday rising to its highest since November 2022. And at this point, really, in addition to being supported by year-end flows, but really the broader theme of dollar dominance and US exceptionalism carrying through. And we are expecting the Bloomberg dollar spot index to carry through on path for the best year since 2015. But that year-to-date gain there, about 7.6%, the strongest level since 2022 that we saw earlier this week. So that year-end rebalancing at play, but of course that broader theme of the dollar strength has been very, very much one that we've been watching all year. Dollar China is also one to watch. We do get China PMIs a little bit later in this session, and really expected to see that sort of continued weakness and a lot of that challenge when it comes to what Beijing can do going into 2025 to lift the sort of fiscal spending, and whether that can improve confidence in household spending in a manner that is significant. Well, some of the biggest stories that we're following from around the world now, and Venezuela's top court has imposed a $10 million fine on TikTok over viral challenges that killed 3 children and injured dozens of people in recent months. It also ordered TikTok to establish an office in Venezuela. The judges say that the money from the fine will go towards a compensation fund for victims. US President-elect Donald Trump has endorsed Speaker Mike Johnson, avoiding a potentially crippling leadership fight in the House. Johnson also earned the backing of Elon Musk, who has become a close advisor to Trump. The House is set for that vote on the Speaker role on January 3rd. Let's take a look at how we are just getting some breaking news crossing the Bloomberg at the moment when it comes to Korea. The South Korean probe team into the aviation disaster over Jeju Air just over the weekend now saying that the court has rephrase that. This is the investigation team into, of course, the declaration of martial law. The probe team saying that the court has issued an arrest warrant for President Yoon. This was really, as we continue to see, really the ongoing uncertainty and turmoil in South Korean politics, even with, of course, something of a temporary respite as the acting president and the government really being forced to pause their political fight to respond to that deadly plane crash that killed 179 people over the weekend. But of course, at the same time, we continue to see the uncertainty when it comes to these political risks, what 2025 potentially holds in terms of a snap election, and whether or not we see sort of further impeachment fights happening with the rest of the cabinet. We'll bring you more as the details come to us. This is Bloomberg. China's December PMIs are out in the next hour. Just the latest gauge of a recovery that remains mostly elusive despite stronger stimulus. Our China correspondent Min Min Lo joins us now from Hong Kong. So what are we expecting from this set of numbers?
Yeah, pretty mixed numbers according to economists' forecast. If you look at the manufacturing PMI, expected to soften to 50.2 from 50.3 the previous month. This is partly because of seasonal factors towards the end of the year. And if you look at the non-manufacturing, that's expected to tick up slightly to 50.2 from 50 the previous month. This is supported by an increase in travel-related services, plus a rebound in construction. And that is largely due to those infrastructure-related fiscal fiscal spending. But if you peel back the layers, look at the past few months' numbers when it comes to the sub-indices, especially when it comes to employment, that had remained well below 50 over the past few months. It's about 48 for the manufacturing PMI and 45 for the non-manufacturing. So that shows that businesses largely are still very pessimistic about hiring, which doesn't really bode well for people's confidence around their income growth and employment prospects. So overall, it's still that story of weak domestic demand being offset by resilient overseas demand. We do expect exporters to continue to front-load shipments to the U.S. ahead of Trump's inauguration, and that's largely being expressed in the forecast for the Taiwan PMI, which is due on Thursday. That's an unofficial data capturing some of the more smaller export-oriented firms.
We're also expecting President Xi's New Year's speech later on tonight. Will there be anything that traders, economists will be wanting to hear?
A short answer is not much. Of course, traders will be wanting to hear some sort of affirmation from President Xi around some measures to revive the economy next year. But this is his usual end-of-the-year speech where he would usually give a wrap of the year, just tell us about the achievements and the challenges that China has faced and confronted over the past year. He might highlight in particular some of the breakthroughs China has had, for example, in science and tech, in space and innovation. He's going to highlight that people's social welfare is still going to be a major priority for the government, because this is a time for him to really connect with the domestic audience and really show people that he really cares about the bread and butter of people's livelihoods. He might set the tone for next year as well. He may perhaps touch a little bit on the mark that China has left when it comes to foreign policy, foreign affairs this year. But when it comes to next year, he's likely to perhaps give us a little bit more affirmation about next year's economy, but we're not holding our breath for any sort of big market-moving information tonight.
In terms of the year that was, how do we characterize, the sort of markets volatility that we've seen, as well as what we might expect next year?
Yeah, indeed. It's been a volatile year for Chinese markets, and we started the year with Chinese stocks really underperforming the broader Asian benchmark. But it was really that September stimulus-induced rally that really, moved stocks up. If you look at the HSI and the CSI 300, CSI 300 is looking at its best year since 2000, and for HSI, it's the best year since 2017. That's really boosted by that September rally of 19%. We're ending the year with Chinese and Hong Kong stocks outperforming the broader Asian index. But then if you look at the bond market, it's a different story. The bond bulls really riding high into the year end and into next year as well. We're looking at bond yields at record lows, again on expectation of more interest rate cuts from the government. But it looks like bond market investors really lack the conviction that China's economy will reflate on the back of these economic policies. And in terms of what we're looking forward to next year, and one of the other big risks as well, I forgot to mention, is the Chinese yuan, because we are looking set for a third straight year of depreciation. The pressure on the yuan only going to increase next year as we head into, Trump's incoming administration taking office in January. And if you look at policies next year, which sectors are we watching? This year, consumer staples has been one of the laggards. I think it was just slightly better than, I can't remember what was the worst performing, but consumer staples was not doing very well. We expect that the consumer staple stocks will benefit from policies next year, especially the elder care, child care. These are sectors that we are watching very closely given measures that are announced, especially targeting the boosting of social welfare. Financials had been doing very well this year, partly because of those record dividend payouts on the back of the capital market reforms at the start of this year. We continue to expect that trend going forward. And of course, all those stocks related to the theme of self-reliance, the tech stocks, those have been really outperforming this year. We continue to watch those stocks very closely in 2025 as well.
Bloomberg's China correspondent Min Min Lo there. We're staying with China, and we spoke with Minneapolis Fed President Neel Kashkari last month about how US President-elect Donald Trump's potential tariffs on goods from China may affect global trade.
There's obviously the risks of potential tariffs back and forth between the U.S. and China, which are notable. The other big concern is just the domestic Chinese economy and the slumber that it appears to be in from our analysis, the heavy weight of the housing sector that has been a driver of Chinese growth for so many years is now appears to be weighing down the Chinese economy and just the struggles that the Chinese economy is facing. And so I'm just something that I'm watching a lot is what the policymakers in China do, and can they get the Chinese economy on a stronger, sustainable growth path, reinflating, so to speak, their housing bubble. Doesn't seem like it's a long-term strategy. So what is China's growth strategy? I agree the potential tariffs between the U.S. and China and back and forth is something to pay close attention to. But I think China's own domestic challenges are also notable.
Do you think that if China's economy remains lackluster, we could see some contagion and other Asian economies and perhaps even further afield may get impacted as well?
Certainly possible. I mean, China is obviously a huge economy, and if a huge part of the global economy just grows slowly, that's obviously going to have an imprint on everybody else. For example, commodity markets would be one of the first places that we would see that, whether it's for steel or for iron ore or other metals or other minerals. So that's something that we're going to pay close attention to because it just matters a lot for the global economy. But then I also think many other Asian economies are linked to economies all around the world. I was just looking at some analysis on where the U.S. imports most of its goods. Of course, China dominated that 6-10 years ago, and China's share exporting directly to the U.S. has actually fallen quite a bit. And countries like Mexico and other Southeastern Asian countries have picked up the slack. And so I'm actually optimistic that other Asian economies could continue to perform well because they're connected to the U.S., they're connected to Europe, to South America. But of course, China is just so large that what happens in China matters to everybody.
Minneapolis Fed President Neil Kashkari there speaking with Insight anchor Haslinda Armin. And of course, as we take stock of the year that was, there's no denying that the story of US exceptionalism, be it you talk about US stocks or the greenback, is really the dominant theme, right? When it comes to the performance of the US dollar, it was the best year in just about a decade. The Bloomberg Dollar Index rising against all G10 FX in 2024. And the question over whether that can continue, of course, so much of that hinges on what we see from the Fed, as we heard earlier from our guest Vishnu Varatha and from Mizuho, saying that it has embarked on a very atypical easing cycle, and so much of that depends on the force of fiscal measures that we see from an incoming Trump administration, the impact of any measures on immigration as well as on trade, and as well hinging on that China recovery story there as well. So a lot of uncertainties as we head into 2025, but there's no denying that the greenback really one of the big winners out of 2024. Well, investment management firm New Century Advisors is warning that traders and the Fed can't take US labour market resilience for granted. Their chief economist, Claudia Sahm, told us more about the potential blind spots for the economy in 2025.
If we could keep it as it is right now, largely, this would be another great year ahead of us. We've been surprised at how well the past 2 years have gone, particularly when you think about growth and how the consumers have held up. But that doesn't have to keep going. So what we really want people to focus on are the blind spots, right? What could go wrong? Who isn't getting enough attention? And I think one area, if I had to maybe point some Fed officials to a blind spot, I think, they showed a lot of complacency in their last summary of economic projections on how well the labor market would continue to hold up. What we saw them kind of write down, the typical official, was something that basically has the unemployment rate sticking about where it is right now for the next 3 years. That's a pretty remarkable and frankly would be very unusual path to the labor market. And yet there was all kinds of concerns about inflation and the uncertainty around inflation. But I think I'm still concerned that there are things in the labor market, while good, don't quite look like sustainable. And that's where the problems can come in. And so that's one area that I think is Claudia,
so if I ask which is a bigger risk, a weakening labor market or a stubborn inflation, you're going with the former rather than the latter.
Inflation's fine. right now. I mean, we are really not that far from 2%, and we've seen a lot of encouraging signs under the hood that we are getting to this last mile on inflation.
But right now,
the labor
that's
market
before tariffs. That's before we deport millions of workers. That's before Donald Trump comes into office. So things could change drastically after January 20th.
Absolutely. They could change drastically. And I think it's appropriate that we have had a very deep conversation about the policies that have been put on the table. And there have been a lot of policies put on the table. And it's really important to have this conversation and talk about some of their potential pitfalls. And maybe we won't see all of them put into place. And that probably would be a good thing for the economy. And yet, kind of taking for granted the good stuff that we've got going in the economy that's a little more nuts and bolts, like the labor market functioning, and just saying, oh, well, that'll just keep going. That's all fine. It's in a good place. I think that's that could be a real mistake in terms of, because the labor market in particular is always and has been the past few years such a linchpin to this amazing period of a big disinflation, growth has stayed strong, and unemployment has stayed relatively low. And that's something we want to keep going.
New Century Advisors Chief Economist Claudia Sam, they're speaking with our colleague Matt Miller. And just to get you the latest across what we're hearing across us at the South Korean political turmoil situation, the South Korean probe team saying that the court has issued an arrest warrant for impeached President Yoon Suk-yeol over that declaration of martial law. According to investigators, a joint investigation team had requested the arrest warrant on Monday after Yoon failed to appear for a third time for scheduled questioning by the Corruption Investigation Office for high-ranking officials. So we knew that the investigators had been seeking that arrest warrant after he defied multiple summons for questioning over his declaration of martial law. If now that we're seeing that being granted, Yoon would be now the first sitting president in South Korea's history to be arrested while still in office. It is uncertain if investigators would be able to take him into custody, and we see this really against the ongoing political chaos in South Korea, which has been recently compounded by that devastating air crash over the weekend. Take a look at what we're seeing when it comes to this holiday shortened session here in Australia. As a reminder, local markets close in just about 2 hours and 15 minutes time. It's a 2 p.m. End to the session here in Sydney. We're seeing a bit of downside. Some of the miners and the banks are the big movers today, but of course it has been really a record-breaking year in terms of this stock rally for Australia, and that is largely seen to continue with solid performances expected in 2025, particularly watching the likes of the miners and the banks as being some of the thematics that we see in the new year. The Aussie dollar is not seeing much of a move, 62.15, but of course a lot of this is against a broader backdrop of just the robust dollar strength that we continue to see. New Zealand markets will also be closing early, as well as Singapore today as we head into New Year's Eve. Well, Australia's Westpac consumer confidence gauge declined in December. Persistent inflation, elevated interest rates adding to the uncertainty headed into the new year. Westpac senior economist Matthew Hassan said that it reflects a loss of confidence around the outlook, particularly for the economy. Bloomberg Economics, however, does see Australia's growth picking up in 2025 as the RBA belatedly joins the global rate cut cycle. Let's get more on the outlook with the Australian Retailers Association Chief Industry Affairs Officer Fleur Brown. Flo, great to have you with us, and an early Happy New Year to you. Perhaps we'll start with the sort of taking stock, I guess, of the year that has been. Has it been as challenging that as the consumer sentiment data would suggest for Australian retailers?
Thanks, Heidi. It has been a really challenging year, in many ways the most challenging year since COVID for retail, because we've not only seen subdued consumer spending all year, apart from, occasional bursts, and often they coincide with sales activity. But the cost of doing business has been really high for retailers. And of course, that comes from many different directions. It might be insurance, energy costs, supply chain costs in terms of increased pricing from suppliers overseas or even local suppliers. The cost of retail crime has also added to the bottom line. So those have been some of the factors, along with a whole host of distractions for retailers such as the industrial relations reforms that we've seen, the biggest in decades in Australia. And when I call them a distraction, I mean, really that it's just a lot of change in 1 or 2 year period where there's a lot of execution required, which is a distraction from business as usual for retail.
Did we see any periods of sort of punchy spending, though? Because seasonally, of course, Black Friday seemed bigger this year than it has ever been in Australia, and we've just been past Christmas. Have you got the data that shows, whether that was on par with previous years?
There's definitely been bursts of punchy spending, to use your words, and Black Friday was a really good one. We saw a projected 5.5% year-on-year increase in Black Friday sales activity. We have to remember, of course, when it's sales periods that we're looking at a different margin opportunity for retailers, but nevertheless, really exciting to see that continued growth. It is still a young event compared to something like the US Black Friday version, but great to see that it's really charging forward.
What do you think, the members that you represent would like to see in terms of perhaps making 2025 a little bit easier, particularly as we are still probably at least 6 months out from the RBA starting to join the global easing cycle?
Well, certainly increased confidence for business and consumers is top of the list. We are mindful we're heading into an election cycle, and it's very much a top-of-mind conversation that we're having with political leaders, is having a growth mindset for retail. It is 18% of GDP for Australia. It employs 1 in 10 Australians. It's a really significant contributor to overall economic well-being, and we really need to get retail back on track. Interest rates are really the crux of it when it comes to consumer confidence. Of course, there may be some spending articles in the election strategy, but we're not expecting anything hugely substantial. It's really the interest rate factor that's going to have the greatest impact on consumer confidence and spending next year.
It's interesting because you've also seen data that suggests that, consumers are a lot more selective than ever. Certainly in a lot of other markets, there's more spending on experiences than, on goods. But contrast that against the fact that you're still seeing some of these sort of broader trends focus on ethical production and sustainability. Is that still something that is top of mind for consumers?
Absolutely. It's top of mind for retailers as well. I mean, it's fair to say that retail's a very responsive industry. So if it's important to the consumer, you can bet, they're going to be responding fast. So investing in artificial intelligence is a really big priority for Australian retailers. And it's actually something we'd like to work closely with with governments on in Australia. We feel that it's an important area of growth, particularly for small business. We've seen the increased rise of disruptors like Temu and Shein in this market. In order to compete, Australian retailers really do need to invest in technology and artificial intelligence in particular. Sustainability is another innovation opportunity. We have seen it as a problem to solve. It's now in the camp of a differentiator, an opportunity for growth, an opportunity to engage more deeply with customers. So that does require some investment. And once again, we're saying to governments, it needs to be co-investment in this space. We all need sustainability and environmental concerns to be a big part of our agenda moving forward, and we need to move forward with the community in that area and have some co-investment.
That was my question. Do you think that should be the government's problem to solve, right, when it comes to putting limitations maybe on these suppliers overseas of low cost but ethically, I should say, questionable goods that are coming into Australia?
Look, it's early stages of that conversation. We're looking very closely what's happening in overseas markets, of course, to see what measures have been put in place. We're mindful that in Australia, retailers they're up for the challenge of competing, but we do need to work really closely with government to make sure that the frameworks that are put in place from a policy point of view are helpful and not harmful. And sustainability, again, it's a differentiator for Australian retailers if used well, and that's an area where we'd like to co-invest with government. I mean, there needs to be co-investment in waste recycling infrastructure in Australia. It's not something industry can do alone. It's something that government needs to co-invest in, and Australian consumers need to come to the party too and recognise the importance of that and the role that they play at the end of the day in that chain.
Flo, really great to have you with us, Flo Brown, who's the Chief Industry Affairs Officer at the Australian Retailers Association. We'll have a lot more in Australia ahead in 2025 every Tuesday at 10:40 a.m. if you're watching in Sydney, 7:40 a.m. if you're tuning in from Hong Kong. Plus, tune in to the Bloomberg Australia podcast, delving into the biggest stories shaping the country's role in global business. This is Bloomberg. Take a look at some of the corporate stories that we're tracking. In India's Adani Group is getting out of his consumer joint venture Adani Wilmar in a $2 billion multi-phase deal. An exchange filing shows Adani Enterprises will sell its 44% holding in stages to Singapore's Wilmar International. Adani plans to use the proceeds to bolster its core infrastructure business, including air transport and renewable energy. Separately, the CEO of Adani Green Energy, Amit Singh, will step down at the end of March to assume a new leadership role within the conglomerate. Singh will be replaced by Ashish Khanna, who currently leads the group's international energy business. The change comes as the company faces US allegations of offering bribes to get power contracts. And as the year draws to a close, we're seeing a flurry of IPO filings in Hong Kong for early 2025. Yibin Bank is seeking up to $245 million with trading set to begin on January 13. Other firms joining that year-end listing frenzy, including the likes of WeDoctor, Brain Aurora and Contiocean. 2024 was the best year for Hong Kong's IPO market since 2022 in terms of total volume. And a pretty good year when it comes to the Hong Kong dollar too, at least at the moment, reaching its strongest level in 3.5 years on Monday. That's been driven by year-end demand, a surge in short-term borrowing costs at play there too. The overnight Hong Kong interbank offered rate, or HIBOR, soaring to a record high of 6.5%. Banks replenishing liquidity to meet regulatory requirements, strong demand for Hong Kong dollar as well. So we are expected to see the interest rate premium for Hong Kong, dividend-induced demand to push that currency below 7.76, with a seasonal cash crunch providing an added tailwind. Well, that is it for the Asia trade in 2024. We'll see you again in 2025. Have a happy and safe New Year.